Well, hello, it's Chris here from Capital Council and welcome to another Meet the Fund Manager Investment series. Today I'm kindly hosted by Charles Hamieh from Clearbridge Investments. He's the Managing Director and Portfolio Manager. Charles, thanks for joining us today.
Chris, thank you for having me, and hello everyone listening in.
I've got a few questions for you, certainly around that infrastructure asset, certainly with interest rates rising, inflation rising. We're in this sort of volatile market at the moment, but perhaps the first one really is, for the benefit of the listeners, is what is infrastructure and why is it such a compelling investment?
Yeah, thanks, Chris. So that's a very important question because the definition of infrastructure has certainly evolved over the almost 25 years that I've been involved in the asset class. For us, there is really two key parts of that definition. Firstly, you have those regulated assets or those contracted utilities. So they're your water companies or gas companies, electricity companies, your renewable energy companies, where you have, typically an independent regulator, asset-based regulation. They're very defensive businesses, very resilient in almost any economic cycle. Then you have your user pays assets. Now, these are typically concession-based assets. So think about your transurban toll roads, think about your airport infrastructure assets, a bit more sensitive to economic cycles, so a bit more leverage to GDP, but a bit higher growth, higher returning assets. So that's sort of our definition. Around that, there's other parts of the universe, but for us, it's in these two parts of the universe that we get the best risk-adjusted returns to equity, where we can preserve capital and capture the appropriate amount of upside in rising markets.
Oh, that's good. I get this question all the time, just with inflation rising. But is infrastructure a good asset to hold with rising inflation? Is it a good hedge?
To be honest, Chris, it's probably no better asset class to hold to give you protection against rising inflation. And this is a function of the fact that most of the revenues are linked to inflation. Now, if you think about the pricing mechanism that many of these companies operate in, it's typically regulated or contracted. And within regulation or concession agreements, there's a very clear methodology to allow inflation to be passed through. So the risk of inflation is borne by the user of the asset, you and I. And that's very different to other asset classes where there's a perceived hedge, like real estate trusts or commodities or other real assets, where that inflation pass-through is much more supply and demand driven. Within infrastructure utilities, it's very clear. You have monopoly assets or oligopoly assets with very low demand volatility because they're essential services, and very strong pass-through of inflation in the contracts or regulation. Also,
just with the stability of those returns, are they there? We've got a lot of retirees that are demanding income to put food on the table. Is there some strong stability in those returns?
Again, very, very stable. Think about these assets. These are essential services, water assets, electricity assets, very resilient and predictable cash flows underpinned by regulation. Whether an economy is growing or not, these assets are used. They're essential to society, and the drivers are very different to economic outcomes. And that means you get very stable dividends, and dividends which can grow at well above inflation. What drives dividends isn't inflation, because that's passed through. It's the asset-based growth in these sectors. So, you have strong inflation, you have strong dividends and strong dividend growth. So again, the sector is very unique in its ability to have very strong dividends underpinned by very strong cash flows.
There's also a move to renewable energy. And why so much invested in infrastructure assets?
Well, I quite often say to everyone really, that there's no sector more at the forefront of the need to decarbonize than infrastructure and utilities. The need to get to net zero by 2050 is going to require significant amounts of capital expenditure. Almost $1 trillion a year for the next 10 years or so, if not longer. So it's a decade-long structural tailwind. And fortunately, a lot of that capital expenditure will occur within the listed part of infrastructure. So changing the way electricity is generated, the way it's moved around society, the way we move around society. A lot of that CapEx will occur in the listed companies. And that's going to really underpin very strong asset-based growth for many, many years. And we're seeing it now. You know, if you think about the various legislation that's occurring in Europe, the US, even in Australia, we're seeing that, you know, that data now emerge in terms of asset bases now growing to meet the demands of renewable energy, strengthening transmission and distribution lines. And that asset base is growing in an environment of allowed returns. So the companies are getting very appropriately incentivized to spend this money and grow their asset bases.
Huge market. Final question, bond yields. What's the impact on the portfolio typically with the rise in bond yields at the moment?
Well, certainly there's two ways to look at this. There's the more immediate impact, which is the equity price impact. And we've seen a bit of that happening now. You know, as interest rates go up, you know, quite often assets with long duration cash flows get priced a bit lower in today's dollars. But the actual impact to asset values is very low, non-existent, because like inflation, interest rates are also passed through to the user of the asset. So, you know, regulation is designed to ensure that, you know, firstly, when Chris turns the lights on, the lights come on, so security of supply, but also designed to ensure that variables outside of the control of the company spending the money, so the utility, the risk of that is borne by the user of the asset. And allowed returns are a very accurate reflection of the prevailing cost of capital at that particular point in time. So as rates start to rise, allowed returns will also start to rise. And that's what we're sort of starting to see now globally. So at the asset level, little to no impact. At the equity level, you know, for a period of time, as expectations are reset, there is an impact. But what we quite often see is that as the passage of time unfolds, that impact is you know, it's quickly sort of, you know, quickly reverts to positive. And then the structural stability of the cash flows and everything that's unique about the sector really comes to the fore again.
Thank you. Look, as a long-time user of Clearbridge Investments, more than comfortable with your style and really appreciate your time to speak with us today, Charles. For the benefit of the listeners, again, if you need any more information on Clearbridge Investments, please give us a call on 1300 882 166. But again, Charles, thank you very much for your time today.
Chris, thank you. As I said earlier, I've been involved in this asset class now for 25 years. And in terms of the structural tailwinds, we're as excited as ever. So thanks for everyone for your continued support.
Perfect. Thank you.